What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is January 20th of 2022. Well, folks, I hope you are having a fantastic day wherever you are, and in today's video, I want to go about trying to answer a big question, and that is whether or not the market is simply, at this point, too bearish. Are crypto investors at peak fear, and are prices inevitably going to rebound here within the short term? Or do we still have more downside to go? The reason I want to spend some time talking about this, and I'm not upset about it at all, but some people have asked me in this case, Nick, are you just simply being too bearish at this point? But I want to try to provide the idea as to why, in the short term, I do believe that prices do have more room to go down, that we have not seen massive bearish sentiment in the market. And outside of that as well, I want to spend some time to talk about why still I believe we've got the foundation to move up even higher in price as we go throughout the later part of 2022 and after this last major flush in price. So we've got lots of things to discuss in today's video, guys. Whether you agree or disagree, I hope you'll stick around for it. But I do want to ask that if you like the video, consider liking, subscribing, and if you haven't already, hit that bell icon so you don't miss any videos and you get notifications for all of our uploads here if you care about my opinion and you can tolerate my rambling. All right. Let's go ahead and dive into it, guys. Now, I don't want to beat around the bush too long. Many of you guys watch each video or watch videos quite frequently, so I want to go ahead and just very roughly explain where our sentiment is. We believe that right now, crypto markets, or Bitcoin more specifically, is going through a long-term consolidation channel that started back here in January of 2021, so over a full year here. And then we've been having these kind of zigzag patterns of fast rallies in price, sharp corrections over 50%, and this is a symptom of the current market we live in that's driven by leverage and credit. And this is very similar to what we saw back here, back between June of 2019 and October of 2020, right? These long-term sideways consolidation patterns, they're followed by major breakouts in price, like we saw here, and what we think is going to happen here later on in 2022, towards the close of the year. Now, our idea here, where current prices stand, is that we haven't seen the rest of this new flush here that we're going through, that really, I think, started back here on December 4th, and that we're going to continue to potentially roll over down to $30,000, $35,000. Now, I could be very well wrong on this, but again, we've been pretty accurate so far in the sense of our short-term calls on the market, and I want to go ahead and explain why the data is leaning me towards the direction that we've still got lower lows to go. I promise you guys, this isn't me trying to spread FUD. I'm not convinced that we're in a bear market. I think that even if we come down here, it's going to be the catalyst where buyers come in and drive us to new all-time highs. I think we're in the full swing of a bull market, but we need to turn to the data as to why we have these types of conclusions. So let's go ahead and talk a little bit about what I think is probably the best sentiment to understand if people are more bullish or, in this case, bearish in the market. And that is diving into the data for the perpetual futures contracts markets. Now, if you guys remember, if you've watched any of my content over the past year, you probably have heard me ramble once or twice, or more times than that, about the cancer that leverage trading is on the cryptocurrency space. Now, whether you agree or disagree with me on that, some people like leverage and understand that it's a tool and they use it properly. That's totally cool. Some people agree with me and have a more negative sentiment. Doesn't matter. The key point I want to focus on here when it comes to perpetual futures contracts is that they are the largest derivative market and most impactful when it comes to crypto. And on top of that, there is no signs of shortage and growth for the perpetual futures contract market. Right now, just this past week, we set in a new all-time high, 264,000 Bitcoin in open interest in perpetual futures contracts positions. To put that into perspective as to how big the perpetuals market has come in the crypto space, first off, we need to understand it's not only bigger than the spot market where real price discovery happens, but outside of this as well, the 264,000 Bitcoin that are locked in there is more than 12.5% of the Bitcoin supply that will ever exist. It's even larger considering that we aren't at the 21 million coin threshold for Bitcoin, pressing more close to 15%. This is a major important statistic to keep in mind. And what's going on in these perpetual markets will give us a very good gauge as to where users currently stand on the sentiment of the market. So let's go ahead and do a little bit of data exploration. Let's go ahead and see where people stand. Now, I had some comments that people put in the previous video. And again, I like these kind of points, guys. And I think it's not so much criticism or anything, but it's good critical feedback in order to better explain things. And as I mentioned, I'm not perfect. So I want to go ahead and explain something about these perpetual contracts, these perpetual futures contracts. One thing that's very important to note here is that for perpetual futures contracts, there is, generally speaking, especially in crypto collateralized positions, you are going to have a 50-50 split between the longs and the shorts. For every time you want to 5x long Bitcoin or 2x short Ethereum, whatever position you can think of, there will always be a matching person on the other end equalizing your position. If you're long, there's an equal position that's going to be short. And that's a very fair point to put on. That's why here when you take a look at the long-short ratio, you generally get something that's along the lines of a 50-50 split in positions. And this is something that people always point out, which is that, see, the perpetual markets are always even and distributed evenly. But that's not what I want to focus on here today. First off, you see more divergence when it comes to stablecoin or dollar collateralized positions. So that's an important metric to keep in mind. But outside of that, I want to go ahead and see what the general public, the majority of portfolio accounts, feel about the market. Are they believing that the market's ready to go up? And are they long on positions or are they short? Not so much the absolute amount, but I want to see what the general sentiment is, right? Just like how we would get a general sentiment check from looking at Twitter or looking at the fear and greed index, right? To get a sense of emotions in the market. Well, we're going to take a look at the Binance futures data here that is public and available for everyone and is updated on a very frequent basis. Let's go ahead and take a look here at the metrics here for the top trader long to short ratio. And we're going to go ahead and update it here to the daily here. So we can see here since back in late December, the long to short ratio here. What's really interesting about this data here is that we see a lot more long accounts than short accounts. Now again, I want to go ahead and analyze what this metric means, and here's the description. The portion of net long and net short accounts to the total balance of the top 20 users. So we're getting really like the top players here in the market. Where are they positioned right now? Most of them have been long for the past month. Nearly, not exactly, but around 75% of those who are trading on leverage positions are net long. And that has not changed as price has declined. In fact, more people are getting more and more long than they were before. The ratio has been holding out really steady, even compared to back here where it was in December. The long to short ratio is down here at 2.34. It is now at 3, meaning that more people are long than short. For every short position in the top 20 accounts or accounts that are short net, we have 3 accounts that are net long. Now, this makes total sense because the vast majority of people in crypto, at least who are invested in the market or focusing on it, are going to be generally net long and supportive of crypto, right? That's why there's generally going to be more more long accounts than shorts, betting against the market. But this is a big reason why we need to observe the perpetuals market. Until we see more of these accounts going short due to fears that the market is absolutely collapsing, that it's going into a bear market, then we need to realize that the market sentiment is still pretty overwhelmingly bullish. For every 3 accounts that are long, there's 1 that's short that believes price might actually go down in the near term, right? So this is a really important metric to keep in mind here when we're taking a look at it. And again, we can look at the general long to short ratio. If we don't want to just analyze the top accounts, we can see here that the metric's about the same, if not worse, and smaller accounts, with back here having a peak around 3.55 on the ratio and still holding around 3.1. From the large accounts to the minnows, we can see here that the market is still pretty overwhelmingly bullish, at least with their actions. And we can see the same here as well when we take a look at the Binance futures, when we take a look at it in the form of crypto. It's generally going to be about the same ballpark here. A little bit lower, right, around 72% long to 27% short. But again, still holding out here from around mid-January for the past couple of weeks, and still much higher than where we were back in December, where there was a lot more short positions. Back around here in December, right, we had 42.52% for the top traders being short, and that has remained relatively minimal and decaying as we've gone throughout time. So most of the market thinks that there's going to be a recovery here. So what's my point in all of this, right? It's not just enough to look at the fear and greed index in the market, right? The fear and greed index can remain greedy or fearful, right, in those exacerbated areas for a prolonged period of time. We saw this back through May and July, right? And also we saw it during the rally from January to May, right? Even though price really didn't move much higher greed held for a very long time and started to, again, start to showcase really a trend reversal ahead of time here before really the decline started. So even though the bearish sentiment is still present in the market, it's very clear by most of the leading indicators, we need to see the final flush. We need people to be at a position where they're either getting liquidated out of their positions or they're flipping the coin, they're down on their excessively leveraged long positions, and they're like, you know what, the market's done, I'm gonna short it, I'm totally out of this place, crypto's crashing, it's done for. And then as everyone's piling into the shorts, as the short positions build up on the spot market, the whales who like to buy real physical Bitcoin are going to buy heavy. And they're going to drive the price higher and cause even more pain liquidations for the emotional traders. That's how it works, guys. Greener pastures, rallies, and price are usually found in fear from emotional traders and investors. Now, I'm not saying if you disagree with me that you're emotional by any capacity. What I'm saying is that in the market, the emotional traders fuel the kind of price action that institutions like to buy. They want you to continuously believe that things are going to be good, they're going to keep going good, and then finally, once you reach that final point here where the price is really starting to decline at a dramatic rate, you go, oh my God, I got to sell my coins, I got to close my positions, I'm going to short the market. That's when they move in, that's when they buy, and they use that emotion to their advantage. Now, one quick thing I do want to share with you guys here that I think is much better than going out on leverage trading. You guys will not see any referral links here to leverage trading here on the YouTube channel. One thing that I will say I think is a really good tool that you guys can look at using is iTrust Capital. This is our sponsor for today's video. They're a partner here on the channel. Now, iTrust Capital is a cryptocurrency IRA investing solution that also gives you exposure to commodities like gold and silver and allows you to have a convenient cryptocurrency IRA account. Now, one really important announcement I want to make here for iTrust Capital is the recent announcement that they just raised their new raise out here around $125 million at a $1.3 billion valuation. A massive raise for iTrust Capital alongside its lead in the round, which is Left Lane Capital based in New York City. And I want to go ahead and just take a moment here as one founder to another to congratulate Anthony and everyone else at the iTrust Capital team that I've gotten to know as you guys have been building this product. I know there's a ton of Data users who have loved using iTrust Capital, and I feel like you guys might enjoy it as well if you haven't checked it out. So if you're interested, check out the link down below in the description. I think the raise speaks volume about the platform, and they've got some really cool metrics that they released that they've had over 27,000 funded accounts, and they're planning to get all the way up to 180,000 to 200,000 in 2022. I think that's only going to come if we see a continued rally in the bull market here, which I'm quite confident we're going to see. So best of luck to the iTrust team on that. Now, outside of this as well, I want to go ahead and talk about the macro perspective because it's not just this internal enclosement of what's going on in the crypto market, guys. Why are markets still fearful, right? I think one thing that's important to note is as we talk about the derivative markets are tracking the spot market. So if we're seeing Bitcoin going down in price over time, and I'm confident that we're still going to see a little bit more decline than before we see the upside, some of you might be wondering, Nick, what's your reason for being bearish? I mean, Bitcoin at 40K, I mean, we haven't even seen the wave of institutional capital, all these things. Why are you still bearish? I think a big reason for it is because right now, general asset markets are a bit concerned by the pressure that we're seeing from both the central bank of the United States, with Jay Powell at the head as chairman of the Federal Reserve, and under the Biden administration to curb the fears that have been growing around inflation. Now, I got to be honest with you guys. I think the central bank, and this is again another contrarian view of mine, I don't think the central bank is really going to walk the walk like they're talking the talk. They're saying they're going to do a lot of tapering in the market in the sense of increasing interest rates, stopping the printing of money through quantitative easing. And they've been basically going on that they're going to do this, when in reality, I think that they're going to cave into the asset markets that are going to complain, the stock market collapsing, right? Which I think we're in the process of doing right now, kind of a short-term sell-off, a taper tantrum, if you will, where the markets say, no, we can't survive without low interest rates and money printing. The market's going to crash, and it's going to be the Fed's fault, and the Biden administration's fault, or whoever, right? So there's this kind of tango of inflation, which does need to be curbed through higher interest rates and a reduction of the printing of money. But at the same time, asset markets, which are going to throw a fit in this case if things don't go their way and remain the same, if we don't keep kicking the can down the road and repeating the same mistakes, right? So what I want to go ahead and point out here is how asset markets as a whole generally can showcase bullish and bearish price movement. Just like, for example, back in February and March of 2020, how Bitcoin corrected sharply back here. We also saw that in equity markets. Take a look at the Russell 2000, the 2,000 small cap companies that are measured within the U.S. equity markets. Recently set a peak here in November, and since the Fed news has really come out, it's been dragging down below to lows that it hasn't seen since January of 2021. Over a year's worth of potential gains made. Excuse me. Burping. Over a year's worth of gains made in the market, wiped away here within a matter of just a couple of weeks. Just a few months. Markets are starting to signal that they don't like the talk that the Fed is giving, because if we've learned anything, the motto has been this. It's been buying the dip because you know the Fed isn't going to disappoint. The Fed would always come to the rescue. Janet Yellen, Ben Bernanke, Jay Powell, didn't matter what face you had at the Federal Reserve, they were going to come in, lower interest rates, continue the quantitative easing, keep the punch bowl full, and keep the party going. Well, here on the Russell 2000, we are not seeing that. And if we take a look at the longer term chart here, this is where things can get really interesting. If you look at the historic length here back to 1987, when the indice, where at least we have the data for this indice at the Russell 2000, we can see here that the Russell 2000 has hit the red band here. And when we come up towards this red band, usually there's going to be a 30% plus correction, if not worse, right? Now again, it's not a guarantee here. We're not saying that it's absolutely got to come down this much. But as market prices continue to come down to this range here towards this green line, the Fed is likely going to step in and do something about it, right? We've already gone down about 15. Actually, technically, I got to adjust this here. I was doing the T the other day. We're down 17% here, right? And this means that we could likely have as far as another 15% to go here. So again, markets showcasing some pretty negative sentiment in the equity space. What about the Nasdaq, right? Well, long-term perspective here, we're not as inflated as the dot-com bubble, but generally speaking, we've been able to escape the oversold period of time back here in 2008, come up and make the green line support once again, the lower band, and tech stocks have gotten closer and closer to that red line, which we've seen many times in the past is usually a period of time to get a bit worried, right? And again, the key point is this, guys. If the Fed does stop printing money and starts contracting interest rates or increasing them more specifically and making the cost of capital more expensive, all assets are going to get hit, plain and simple. But what I think we are going to see here is we're going to see the fear play out into price. We're going to see this major correction here, this 20-25% correction in price down here to $30,000. Right? A lot of people worried, just like they are in equity markets, that the Fed is going to do something. They're going to continue to increase interest rates or stop printing money, and it's going to kill the asset markets. And then Jay Powell is going to come out and calm the nerves of the market, and asset prices will rebound strongly. Wouldn't it be beautiful if those two things, the excessive emotions of the market where people are leverage trading, all the short-term people trying to make a quick win overnight, get caught up within this Fed news, and then we have a beautiful breakout in price. I think that's very likely to happen. Maybe I'm not exactly spot on, but I think that that's what we're going to be seeing, because I've seen this time and time again. It's exactly what we saw back here in March. Peak fear, and afterwards a significant rebound where we recovered all those losses in a matter of a couple of weeks. The Fed came to the rescue, and it likely will this time around as well. What it'll do in the future when inflation gets too big, well, that's a broader question. And that might be a time where we want to get worrisome about asset markets, when the inflationary pressure and the destruction it's doing to the everyday economy is bad enough where it doesn't matter if equity markets pull back 20, 30, 40, 50% and throw a tantrum. Okay? So anyways, guys, I've rambled on enough here. I hope you all have enjoyed this video. Whether you agree or disagree, feel free to leave a comment down below. And if you found this valuable, if you found the content to be valuable, consider dropping a like, consider subscribing, and the bell icon. Guys, thank you so much for the continued love here. Thank you as well, not only for just agreeing with me, but also providing critical feedback. I listen to your guys' feedback where I can. I try to answer the questions that are on your guys' mind. But I hope you know at the end of the day, my biggest sentiment is to give you guys the clearest perspective I can find in the market, and one in which I find is rooted in the data that I have available to me. So it can be of best benefit to you guys. Anyways, thanks so much, everyone. Take care. Have a wonderful rest of your day.